Okay, let's answer some questions from Sunday's Market Outlook. I haven't read any of them, so they're all brand new to me here as I read them. 63 comments, but there's about 20 of the comments that are just comments, so we don't have that many questions to get through. Currently following along Portfolio Management Applied series, learning a lot, glad to learn lessons in the paper portfolio. On the Theta Income portfolio, I had to take a couple of losses past 100% loss rule. Reason it happened, I'm working full time, did not check on the positions often enough. You can use a stop loss on those. For instance, one trade was down 68% in the morning. By the time I checked, negative 120%. Try putting a stop loss limit. That is the problem with the stop loss limit, is if the market moves past. Let's say you have a stop loss on options at 130. And that'll enter as a limit order. And let's say that the options are having a bid to ask of, let's say, 126 to 129. On the stock chart, if you get like one of this thing happening, your bid and asks could jump to 131 to 135. And you'd still have your limit order of 130, but it gapped past the 130 and you wouldn't be filled. Did not execute either due to being a paper account, or the prices moved past the limit. That's probably what happened. Have a limit loss that is a market order, a stop loss, sorry, not a limit loss, a stop loss that executes as a market order as opposed to a limit order. Then it'll just take you out, and it is a paper portfolio, so we don't have to be too concerned about the transaction, about the size of the spread on that transaction, because really you're just trying to get out, right? Concerning Dubai, argument on taxes is undeniable, but it's been a variable for some time. What's potentially been a driving factor for the recent upward push in Dubai status on key refugees for fleeing Russian nationals in their capital. That's interesting. Watching your applied series videos, fascinated by XLY XLP ratio as a leading indicator for SPY. It appears as though this relationship did not hold after the divergence in October 2022. So any indicator in a market, any indicator is a probabilistic indicator. It's not deterministic. In other words, the market does not have relationships like this. If A, then B. No relationship like that exists. It's if A, maybe B, with some probability greater than 0. That's about the best that you can say. There are some very strong indicators where the probability of B happening, if A then B, is very high, but they are all simply just probabilities. All indicators are probabilities. So if you have 1, 2, 3, 4, 5 indicators, and you combine these indicators into an index of indicators, you have a higher probability that if your index that you create is trending upwards or trending downwards, that it is probably more than likely the right direction, that you can infer something out of that. And we do use something like that called the leading economic indicators, and we know that they've been pointing down for some time and they are in recession territory. We are more confident when a confluence of indicators all say the same thing. But one indicator at any one time is probabilistic, and it has a tendency to be of the form if A then B. But not the absolute deterministic outcome of being if A then B. So yeah, any indicator we have is at best probabilistic. What else do we have here? I recall that in Portfolio Management Series you included the NOK in your currency watch list, expecting it to appreciate against the US, given that the Norges Bank raised interest rates last week by 25 basis points, but expects no more hikes, at least till December meeting. Do you see any other factor that could support a long position in NOK? Oil prices. It has become uncoupled from oil prices. a lot of the petro currencies, even the Canadian dollar, could be considered to some extent a petro currency because of Alberta. A lot of the petrodollars became more attached to interest rate differentials over the last year because you had concerted interest rate increases across central banks across the globe. But as more and more of them are getting near the end of that cycle, some of the older drivers should start to come into play, like oil prices. So we have a big jump in energy prices this morning, which should be if we can get past the interest rate differential story, it should be positive for the Canadian and the NOK. But it's a question of, well, what is the Fed going to do? And if we think the Fed, or the market believes the Fed still got more room to go, interest rate differentials are still going to rule the currency trade. So we're not going to get to trade flows as of yet. But as soon as we can sort of put that in the background, there'll always be interest rate differentials in the direction of differentials. But if that can sort of, flow to the background as being less important or less volatile, then yeah, sitting in behind there with Brent crude over 90, over 95 now, that should start to take effect. One of your videos on income strategies use both adjusted margin. Oh, we answered this one in the Sunday Q&A session. So I'll just scroll past this one. Let's see. How would you evaluate portfolio? Okay, Albriana, could you elaborate more on both beta weighted delta and dollar beta weighted delta, and why they are used? I understand the calculation, but I understand less about why I'm calculating them. It's so that you can compare sizes on a risk-adjusted basis. So instead of saying, well, I got 10,000 in this stock and 5,000 in that stock, what if the one that you have 10,000 in is hardly risky at all, but the one that you have 5,000 in is really risky? So when you're looking at where risk is concentrated in your portfolio, it is the smaller position that might have a much more significant risk concentration than the larger position. So we look at them on that basis to risk adjust them so that we are looking at risk adjusted sizes of positions. If I were to code a macro model to guide your beta exposure, how would you start? I don't know. I don't know the answer to that. That's a big question with, at least half a dozen follow-on questions before I could get anywhere near an answer. Which variables would you try to include? Whichever ones you feel fit the data, whatever look-back period you have. Like if you got a 4-year look-back period, you'll build your model on the first 3 and test it on the final year to see how well it predicts out a sample. Problem with regression is you can always fit it really nice by adding more and more variables, but then it doesn't predict very well because it's too well fitted to the data set. So it's a couple of variables that you think are important, but I don't know. I think if you're going to do it, the variables that you would use would be leading indicating variables, not lagging, and not probably less on coincident, but leading indicators. How do you assess preferred shares in terms of replacing fixed income as part of a portfolio allocation? Well, fixed income is interest, which doesn't have preferential tax treatment, but preferred shares are a dividend. So they do have preferential tax treatment because they are dividends. And they hold fairly close to, if you value them, they're valued like a bond because they do have a par value. How do you assess them? I don't know what you mean by the word assess. So I'm not sure in your head when you say assess, what do you mean? I was comparing ZPR to ZAG in terms of after-tax distribution, yield to maturity, duration, volatility, liquidity. I'm not familiar with ZAG, so I can't really comment on that. ZPR is what's called a rate reset preferred. So in the short term, as interest rates go up, the value of ZPR will drop. But as you get nearer the reset period, if rates are high, all those dividends reset higher. And then as rates drop, the value of ZPR increases, much like a bond. Although ZPR will do it with a lag. The more important part is the dividend, right? Is you're still getting your income component in a more efficient after-tax form, and you're not really reliant on your capital. Let's see. Based in Australia, but only play the U.S. market. One big concern I have is the exchange rate moving against me badly at some point in the future. Yeah. If it reversed the past move it has had over the past 2 years, it would be approximately 25% reduction in the value of my portfolio. Yes, it would. What is the best way to manage this risk, and how do you go about evaluating currency risk, for instance, between U.S. and Australia? If you hedge out the currency, you will make the U.S. Return. So if the asset goes up 10% and you hedge out the currency, you'll be up 10%. But if you have equities, bonds are easier to hedge out because you know what their future value is and you know when you're going to get that value. But how do you hedge out equities? Let's say that you have $10,000 in equities and you try to hedge out 10,000. Well, what if the next day you have 10,000, or let's say 2 months later you have $10,800 in equities because they went up and you've hedged out 10. You're under hedged, so you have to adjust your hedge up to 10.8. So you're constantly adjusting your hedge to protect from the interest rate differential. One other way that I would do it, such that you minimize the amount of exposure you have, is use synthetics. In other words, buy a call and sell a put. Use a synthetic. This should cost you nothing. You can arrange those so that it costs you nothing, and your AUD will serve as margin. You don't need US dollars for margin. Your AUD can serve as margin. So your AUD you can put in a money market fund and get the money market rate. This will be a lot cheaper than trying to buy the shares. Or if you're just buying a broad market index, use an efficient futures contract like ES. That doesn't require you to put anything out, and again, your AUD will act as margin on that. The interest rate will be the carry will be within the ES. So if you're getting the Australian money market rate, you're getting positive carry over here while you have negative carry over here. They should cancel each other out, and you basically have a long position in a portfolio of large cap mix of value growth, large cap value US, large cap value growth. That's what SPY is a diversified portfolio of 500 stocks, albeit with some concentration risk in the top 5. But you can get exposure to other countries without actually having to get currency exposure, either by doing a synthetic with options or using the futures market. You can also do a synthetic on SPY. It'll just take more capital, but if you're looking at certain stocks, see if they have options. And this way here you can minimize your currency exposure. Dividend on TLT is being gradually increasing due to the retirement of older bonds with lower yields and the addition of new bonds with higher rates. In a hypothetical scenario, this implied TLT would ultimately return to its par value, meaning a price of 100. TLT is not priced that way. The price of TLT is the net asset value of the fund, and that is made up of bonds, right? So net asset value is really easy to figure out, divided by number of shares, and shares are created and redeemed every day. Shares, so the share count is not constant. New shares are created and shares are destroyed every single day. With the authorized participants delivering the authorized basket, whatever the basket of bonds is that day, and they can create new shares or deliver shares and get the bonds in return and reduce the share count. But that is how the price of TLT is calculated. It's not based on some par value. So yeah. Let's see. Okay, a couple of questions. What are your thoughts on Chinese real estate crisis? Well, I mean, it's a crisis for the sellers. It's an opportunity for any buyers, right? You have an oversupply and a flat population growth and an oversupply of housing. And in the decade to come, you're going to have negative population growth. So it's going to take some time to clear out that surplus, more time than it would take if you had a population that was growing at 1.5%, 2%. It's not, which means that when you have an oversupply, you don't have new family formation growing to build into it at the same time that you have incomes rising. You have flat population growth, and then over the next 10 years, probably declining population growth based on the demographics of China, where the current under 10 generation is the smallest generation in a long period of time. So over the next 20 years, when they go from 10 to 30, they will be the smallest generation in a long period of time. Well, that is the reproducing generation. Smaller generations typically beget smaller generations as the wealth of a nation increases. So it is a big issue. Could this have a significant impact on global economy? I don't think so. I mean, it's overbuilding in China. There's underbuilding in Canada, underbuilding in Europe, and underbuilding in the US, but it's not as if China can dump all that property onto the global market and depress global prices. Real estate is a local market. So I don't think so. Now you could have defaults on a lot of the companies, a lot of the bonds, and then eventually bankruptcies. But I would hazard a guess that it would be more sophisticated investors that hold those bonds and hold those shares. And that's the risk they take. I don't really see how a contagion would flow out of China. Student loans are resuming payments in October with material increases in auto loan delinquencies. Rising energy prices. Do you think this could reduce aggregate demand enough to tip the economy into a recession? Not really. No. I think at the margin you'll get a slower economy. What tips an economy into recession is rising unemployment. But if you give people paychecks, they will spend it. And gasoline purchases count as GDP. Just as much as running shoes purchases counts as GDP. So if I go fill up my tank and it's costing me $30 more to fill it up, it's not as if GDP will be lower by $30. It just means GDP, that $30 of GDP just came from another source. It came from gasoline instead of running shoes. If the consumer still wants running shoes, they'll use their credit card, because they have a job, they have wage gains, and they'll think that, well, next year is going to be better than this year. I'll have more money. I'll just use my credit card. The consumer, especially the American consumer, will just keep spending until you actually take away their paycheck. They will keep spending. So no, I don't think that this on its own is enough to really do much. Not into a recession. A slowdown, yeah, but any GDP growth over zero is not a recession. That's still just a slowdown. I think anything over negative 0.5, just because of the variability of the way it's measured, would still be considered a slowdown. On the topic, starting 24 minutes. If anyone's interested, Big Short. Okay. Feel the pain you experienced with the ES futures a few weeks ago. I sold my triple Q put option against my gut last week and I missed the leg down. Yeah, the market has been absolutely weak. I pretty much picked the top when I sold. And, I've done this before where I just give up on position because I've waited too long, and I should have just, every time I give up, I should have waited just one more week. Always just one more week. But I was going to give up a couple of weeks before that, and I followed my gut saying, give it one more week. And then I gave it one more week, and I said, well, just give it one more week. Until it was, every second word on Bloomberg was AI, 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 and the market every day just kept going up and up and up. And I had seen this movie in 1999 when it was .com, and the market doubled by the end of the year. You can't take the risk at that point because it had the same flavor to it. And it was like, well, I just can't take the risk. I'm out. But damn it. If something big breaks the economy, there will be a flight to safe haven. TLT should perform nice. This is a statement. This is a statement that analyzes the demand side of bonds. But should we not analyze as well the supply side of bonds? That means the issuance of bonds by the Treasury. As Bridgewater said in the liquidity hole, during decades, the market was hungry for any amount of issuance. Today, with an inverted yield curve, commercial banks are not interested in a long-term bond, and central banks neither are buying. During this year, the Treasury has issued much more short-term debt, and the repo market could come to the rescue, filling the liquidity hole, which it has. On that end of the curve, could all of this make this market much more complicated than the previous one? Here's the deal: if the economy whips out a gun, everyone will run for cover in U.S. Treasuries. That's what's going to happen. Money will flow to safe havens wherever there's safe havens, and that's what will happen. So I'm not too concerned about it. I have the ability to hold, and I'm more than comfortable holding. Right now, the bonds that I'm buying, the 2048s, the August 2048s, 3% coupon, are selling for about 73.2% of par. So you're spending $732 for every bond that you buy, and you're going to get $1,000 back. But in the meantime, you're getting a $30 coupon on 732. So this is called the cash flow yield. It has a coupon of 3%, but a cash flow yield greater than 4%, which is not bad. So my after tax, because there's a 30% withholding on the interest expense, so you want to try to find low coupon bonds, 30% withholding from Costa Rica. So my after tax is somewhere around 3.8%. Sorry, not 3.8. I instead of 30, I get 21 on 732 over the course of the year on an after-tax basis, which is still way lower than the tax I would experience in Canada. So I'm somewhere around 2.9% on an after-tax yield on bonds, which is pretty good. And something will break. As the long end of the curve goes up, there's a lot of loans that are tied to a particular rate, whether it be a 5-year or a 10-year plus a spread. All those are going up. So capital rates were not following money market rates for a while. You end up with an inverted curve. Well, you have a bear steepener going on the long end of the curve. Everybody's cost of capital is going up now. Everybody's. Not just money that was borrowed at 3-month floating rate interest, but money that was borrowed at a 10-year plus 400 basis points, or at the 5-year plus 400 basis points. All of that is going up now. So something will break. Something always breaks. And when it does, there you usually get a cascading effect, and rates get cut very quickly. Let's see. But yes, there is issuance. One of the interesting things, an old governor of the Bank of Canada, David Dodge. I say old, I don't mean age. I mean previous governor of Bank of Canada was. You know how Congress has days of testimony where they call people in. They say, "Tell us, educate us on this topic. What's going on?" Well, he was educating Parliament Hill on debt, And his message was very clear. You guys are on an unsustainable path sooner than you think. This has to end, and it has to end now. You can't keep throwing borrowed money at every problem you come up with. You cannot do it, because your competitiveness in the world we're entering into is going to require massive investments in certain things. So you have to borrow for these investments, which means you have to stop borrowing to meet your day-to-day expenses, which is what governments are doing. They're just borrowing profligately just to meet their operating expenses. If you ever saw a business borrowing money just to meet operating expenses, you'd call it, dead company walking. Well, these are dead countries walking unless they change their ways, and they can change their ways. You need economic growth to be higher than your debt financing costs. So if you take all of the debt that Canada has or the US has, and you say, okay, well, here's the interest rates you're paying on all your debt. Now, some of this debt was issued when there was very low interest rates. So it's not as if all the debt is costing 5 or 5.5%. But if economic growth is lower than the average percentage, the weighted average percentage interest that you're paying, the debt only gets bigger, because your tax revenues would grow at the rate of GDP, and your interest would grow at a rate faster than GDP, which means you'd have to take more and more and more of your tax revenue just to pay the interest. That is an unsustainable path. And especially if you have growing debt going into a recession where growth ends up being very negative, unless you cut rates down to zero, you're going to turn a bad situation into a long, terrible situation. So can the Fed keep rates higher for longer? No, they cannot, because you have a fiscal side, and the fiscal side is looking at the monetary side saying, hey, you're going to kill us. We're the ones that are going to break unless you do something. So let's not forget about all the conversations that are happening behind a curtain that you cannot see between the political side and the central bank side, saying, look, you can't keep doing this. I mean, we're holding on right now, but if economic growth slows, we're in a lot of trouble. You're going to have to cut rates fast. And the central bank is aware of that, because the budget is the largest budget in the economy of anybody's budget. It's more important than any bank. So I think that if any, it's more likely that the fiscal will force the monetary's hand sooner than later. Due to my limitations, I only have a brokerage account with certain firms. That Interactive Brokers isn't one of them, which means I can't use their Risk Navigator tool. We consider making a video for Applied Series using Excel for tasks like risk management, backtesting strategy. That's a lot. That's a lot to do. So no, I probably wouldn't do that. That's a lot. I would probably petition your firm to say, look, the brokerages that you have don't have the tools that are necessary or the tools that are needed. Not only that, getting that done, you need some kind of interface between Excel and Interactive Brokers API that allows you to pull information, because you don't want to enter it manually. I don't know how to code in VBA, which is what you would need. So no, I don't think I would jump into that. Heard an interesting thought today on the current inverted yield curve. QE lowers long-term yields. Yeah, its efficacy as a recession indicator isn't what it used to be. QE, we don't have QE going on now. The yield curve inversion is more a side effect of QE rather than reflective of recession forecast. Yeah, but we don't have QE going on. The central bank is not buying bonds. They are letting bonds roll off. We don't really have QE going on. So, but you are right. If there was an amount of, if you take Japan, Japan's a good example where maybe those indicators aren't meaningful. if anything, the long end of the curve should be under even more pressure because of the bond runoff. Now I know that the central bank is still buying bonds. So if they have 150 billion rolling off this month, they let, I believe it's 60 of it roll off, and they'll buy 90. So they are still in there, in a sense, buying bonds, but the net effect is the roll-off, is they are letting them roll off along with the increased issuance. So the market has to absorb the bonds that are being bought plus whatever is being rolled off on a net basis. So I don't know that I would use QE because that's not what's going on right now. Struggle with the idea of buying the long end of the curve. Supply side, Yellen has announced a huge amount of issuance for months to come. Deficit spending keeps rising. On demand side, Fed has locked in QT. The top historical buying central banks, China, Japan, are not buying USTs anymore. Well, I don't know if I'd say they're not buying. They may not be increasing their holdings, but I don't know if I'd say they're not buying. Because some run off and then they just replace them, right? So they are still buying, they're just not increasing their holdings. And some might even need to sell to defend their local currencies. Yeah, that's true. BOJ's new stand on monetary policy might unwind some of the carry trade. That's true. So that leaves us with just the private sector to bid up treasuries if, when recession hits, flight to safety. Here's my question. Is the private sector really enough to overcome such a large amount of issuance? Yes, I do believe they are. Keep in mind that the largest generation right now is the retiring generation. And many of them, that generation started retiring in 2010 and will continue to retire to 2030. Each generation we measure roughly by 20 years. Well, 2010, 11, 12, 13, 14, you really weren't getting anything in Treasuries, so you had to go somewhere else to get your retirement income. And the amount of money that this retiring generation has is the largest amount of money that any retiring generation has had. You're looking at a major wealth transfer from this generation to the generation after it as they pass on. Well, now they can get returns in bonds that they could never get before. So that somebody that is heading into retirement has the very real possibility of saying, if you grab me that 20 to 30 year bond, my yields today are 4.85%. I know the 25-year bond is sitting around 4.84% as I do this. You could never get that before. You had to take on equity risk, low beta, mind you, low beta equity risk, but you still had to take on equity risk to get that kind of income because you weren't getting it in U.S. Treasuries, but now you are. So I think just the sheer amount of capital that the baby boomers have as they move into retirement can more than absorb these bonds that are offering these yields right now, because you can basically say, look, I can lock in my retirement right now. I can lock it in. That's a great return that I never had before. And if they are, some of them sell their homes and they downsize to a smaller home, that still goes on. Because they don't need a mortgage. They're unlocking value out of their home, and that has to go somewhere, and that is a nice place for it to go. So let's not forget that there is the marketplace of retirees that previous to the rate increases really weren't active in the Treasury market that much because there was no yield. They weren't getting the income they needed, but now it's there. There is a market for everything at a price. So I would be a buyer of Tesla at a multiple significantly lower than where it is. I think it's a good company. I just don't think it's a good investment at this multiple. But, as the price goes down, I would say, okay, well, it's starting to get interesting. If it had a multiple even of twice that of GM, double the multiple of GM, I would say I'm in. But when you have a multiple that is 10 times that is GM, it's like I have a hard time wanting to buy it. But there's a market for everything at a certain price, and as yields go up, the market for those get bigger and bigger. Question is the market for it going to grow faster than the issuance? There is a hump in issuance right now, but here's the thing. I'm absolutely certain, even in these left-leaning governments, that somewhere in there's a group of people saying, we can't keep doing this. I mean, we really can't keep doing this. Can we? We can't keep doing this. At least you sort of hope in there somewhere is a group of people saying enough. Okay, we've done what we've had to do. This is enough. So I like to think there'll be some restraint going forward, but more likely than not, there'll be a push for more revenue going forward to pay for this, and you know who they're going to go after. If you are successful in North America, you might want to think about leaving if you can. Let's see. What would be an optimal asset allocation in the current macro environment? Which sectors do you prefer at the moment? I think optimal's hard to define. Okay, understand how you get to an optimal asset allocation is you need for all your asset classes that you want to include some forecast for the expected return, some forecast for volatility, and some forecast for the correlations between all the asset classes. Forecast, forecast, forecast. Said another way, best guess, best guess, best guess. And it goes into an optimizer, and the optimizer says, here is your allocation. It'll look like this, 5% here, 10, 20% here. And this one here will be optimal, will have the highest Sharpe ratio based on all these guesses that you put in there. And they're all just guesses. It's a mountain of guesses. So how optimal is this? So it is a conditional optimization. It is the optimal portfolio conditioned on you being right. Well, that is got a low probability of actually happening, to be almost non-existent other than pure luck. It's non-existent, really, the probability that you will be right. So, because the probability of the condition is so low, the probability of the statement is low that this is an optimal portfolio. In other words, there's a low probability you'll have an optimal portfolio, so why not just do 60-40, right? 60 in equities, 40 in bonds, and what you can do, considering the current market environment, is get defensive. In other words, lower your beta. Don't lower your percentage, just lower your beta on this one. And bonds are selling off at the same time too, so you might want to lower your duration. Or you may think, well, now's a good time since it's so ugly out there. Like Warren Buffett says, be greedy when others are fearful. Maybe you want to choose a portfolio with a very high duration and a very low beta. So you can, within those allocations, raise and lower your exposure to the particular risk. Here you have beta exposure, you can lower or increase your beta exposure. Here you have duration exposure, you can raise or lower your duration exposure. But optimal doesn't exist unless you accept the assumption that all of your guesses are going to be absolutely right, which is an impossible assumption to accept. So you must conclude that there is no such thing as an optimal portfolio, only your best guess portfolio. So if it's a best guess portfolio, let's just save the work. Let's do 60-40, and then let's take our expectations as rather than saying I expect a return of this with a volatility of this, we can say I expect the risk factor for duration to pay off or to continue to lose. I expect beta to pay off or continue to lose. If you expect it to continue to lose, lower your beta. If you expect duration to continue to lose, move closer to cash. And that's probably as optimal as you're going to get. In other words, look for the satisfactory portfolio, not the optimal portfolio, because the optimal portfolio only exists in a theoretical mathematical model. And that's it. I'm sure there are some finance professors cringing at that, saying, you are ruining everything we're teaching. But they are teaching it. Where are we? What are your thoughts on the increase in corporate bankruptcies happening this year? Yeah, there are a lot, but what the more important ones to look at, the ones that are happening, the bankruptcies that are happening, are not surprising. In other words, if you look at each and every one of them, they were expected. It was just a matter of when it was going to happen, but they were expected. And the more important ones are the unexpected ones and the large ones. So the expected large ones, they were expected. Yes, they were large, but they were expected. It's the unexpected large ones, not the unexpected small ones either, but the unexpected large ones that matter the most. So you have bankruptcies rising. That's normal when interest rates rise. That is normal when interest rates rise. So if I said there is a population of deer, and this population of deer in this particular region are shrinking because the food supply has been shrinking, you would say, well, that's not a surprise, and that's probably a healthy thing because what the deer that are dying are probably the weakest of the herd. So it is beneficial for the survival of the population, survival of the fittest, right? Well, it's the same in an economy. The ones that are failing with higher interest rates are the ones that probably were less capable of adapting to a changing environment. They were probably the weakest ones to begin with. So what will be left is a stronger base of companies that come out of this. So you will expect to see rising bankruptcies. The question is were they expected or were they unexpected? So in this population of deer, you're seeing the older ones die off. You're seeing the slower ones die off, the smaller ones, the weaker ones. Now, if you saw the stronger ones starting to die off, well, then there's some kind of disease in there, not just a shortage of food. Well, then that's a threat to the entire herd, the existence of the entire herd. Well, that's the same thing in a population of businesses. When you're seeing the weaker ones die off, well, okay, that's expected. We're seeing the weaker ones die off. But when you're seeing the stronger ones die off very quickly, like the big ones that are unexpected, that were strong a month ago that nobody expected, now they're dying off, well, then that's not just survival of the fittest. There's a disease in the population. And the question becomes, is there a contagion effect from that disease in the population? In 2008, the disease in the population was exposure to subprime mortgage securities. And all of the CDOs, CDO squared, CDO cubed, all of this terrible debt. That was the disease that was infecting good hosts. It wasn't just a lack of food in the environment, such as a weak consumer or low consumer spending with high financing costs. It was a disease. Look for the big strong ones failing. That's a disease. That's got a contagion effect. That's the thing to worry about. But the weaker ones dying, most of the bankruptcies that are happening are probably expected. Which industries do you foresee outperforming the S&P as the S&P moves down? Always utilities. Utilities have a 100% Utilities have a 100% track record of outperforming the S&P in a contraction. 100% track record. Now, I'm not saying they have a 100% track record of going up. I said they have a 100% track record of outperforming the S&P. Consumer discretionary, or consumer non-discretionary, in other words, consumer staples, outperforms on the way down, but about 80%. Sometimes it does underperform the S&P, but utilities have a 100% track record of outperforming. What makes utilities really attractive is on a going forward basis, if you think about a timeline, is the new investments that have to be made in green energy production. So you have to invest in new producing assets. Well, those are called regulatory assets. And a utility's income grows at the rate that its regulatory assets grow at. Well, it's going to have to do a lot of investment in new assets, which means that its regulatory assets growing somewhere around 6 to 8% means utility earnings can grow somewhere around 6 to 8% because it makes guaranteed income basically off the size of its regulated assets. So it should outperform and probably do quite well over the next 5, 6, 7 years. And utilities are known for very high dividends. 3 to 5%, and for growing their dividends over time at basically this type of rate at about 6% a year. Risk-free rate of 5% seems very attractive, so the typical consumer staples dividend havens seem to be beaten down, continue to be beaten down. Keep in mind the risk-free rate 5% is out to about the 2-year, right? You have very little duration on that, so you have very little capital appreciation potential. Because it has such low duration, you're really there for the yield, and that's it, just the yield. Asset base for utilities, oh, look at that, is a deciding factor for the net income they can achieve. Should we therefore favor utilities that use replacement cost method to value their assets? It's not very common, and I don't know if the regulators allow for replacement cost to be used, because if replacement cost is used and you are valuing your assets upwards, let's say that you had assets at, I'm just going to make up some numbers here, at $1 billion, and you depreciate them down to 800 million, and replacement costs, say they're now $1 billion, and you're back at $1 billion, and you're using that as your asset base, the regulator's going to say, whoa, wait a minute, you've made your money on the 200 million, now you want to make it on 200 million again. So you're making money, you're making a return on the same money twice. That would probably be disallowed by the commission, by the regulatory commission that sets the rate. Reporting, a company may report, or a utility may report their assets at replacement value to give you some idea of what their asset value is, but the regulatory rate, I doubt, would be set on the replacement value, simply because it opens up the door to the possibility that you are getting a return on the same assets multiple times. Let's see, another brutal day for the long bonds. Yep. Do you think it's logical to attribute the rise in yields on the long end of the curve to market participants anticipating higher GDP growth, higher inflation expectations? Well, higher inflation expectations, I don't think so. It's hard to attribute higher expectations to the long end of the curve, because in the long run, inflation will be gone. So if we're looking at the 10-year, sometime between now and 10 years, we're going to have a recession, and nothing cures inflation like a recession. You know, the question is, how long will inflation stay elevated? A year, 2 years, maybe 3, but for 10, the central bank would have crushed the economy long before that happened. So I doubt that the 2-year, even the 20 or the 30, is pricing in higher inflation expectations. Why would yields go up with higher growth? Well, higher growth means money is attracted to equities, because equities are very growth sensitive. That the biggest driver of equity performance is GDP growth. By far, the biggest driver is GDP growth. So if there is a large issuance of debt, it's going to have to offer a higher and higher yield to compete with equities, to compete with the potential return equities feel they can get with higher GDP growth. And that's why they would have to offer a higher return competing in a growth environment. In a slowdown to contraction environment, they don't have to, because once you start getting negative returns on equities, even getting zero in bonds is better than getting negative returns. I don't know what's going on the long end of the curve. I think there is a behavioral aspect going on to it now. Behavioral meaning momentum, meaning the belief that bonds went down 3 days ago, they went down 2 days ago, they went down yesterday, they're going to go down today. That's the idea behind momentum, is you take near-term movement and you continue to extrapolate that near-term movement. And the more people that jump on the momentum bandwagon, the more self-fulfilling that gets, which then begets even more momentum till there's blood in the streets and the only person buying is Warren Buffett, right? I sat for level 3 in August, not completely sure whether I will pass. Could you please give me advice how not to lose all the content from my head? Well, you have the archive. If you have our subscription, you have the archive, which means you can continue to review the videos in the archive, except looking at all your YouTube videos. Well, I don't have any level 3 content on YouTube. One of the ways Canadian government is raising taxes by increasing the alternative minimum tax. Yes, they are. That is something I have bumped into, is that there is an alternative minimum So even if I could use some deductions like depreciation and interest expense to get my income to zero, if I'm otherwise profitable, I must pay some minimum tax. You are right on that. By increasing inclusion rates, limiting deductions, increasing the AMT rate. I think most Canadians aren't aware of this because it's difficult to understand. Well, I've said this before. Every single penny a government spends must come from you. And they're going to get it from you somewhere. Whether it is higher taxes, minimum taxes, more taxes, less deductions allowed, less services offered, and more user fees for those services, they're going to get it from you somewhere. So while it may feel good when governments send you checks for something, they're coming back. They're coming back to get it from you. They're going to get it from you somewhere. Now, it may not be directly on your taxes, but they're gonna get it from you somewhere, which means we all have to be concerned with government spending. You know, if you went out for dinner with me and I said, listen, I'll pay tonight, but you'll pay me back over time. Being that you're not paying tonight, you're getting a whole bunch of stuff for free. It feels good, but you know I'm coming back at you for it. You know you're going to have to pay it at some point in the future, and not only pay it back, but pay the interest on paying it back. So even if you are getting stuff from the government, oh, I get this check and I get that check and I get this benefit and that write-off, they're going to get it from you. And if they don't get it from you, they'll get it from your estate. If they don't get it from your estate, they'll get it from your wealth. They're going to get it from you somewhere. They're going to come back and get it from you somewhere. Or they'll get it from you with inflation, right? With inflation, your incomes go up. Nothing wrong with wage inflation. They love to see your income go up because you pay the same tax rate on a higher amount of money. So they're going to get it from you somewhere. But yeah, there's all sorts of ways that it creeps in. Is there a Canadian version of TLT? I don't know. Macklem will cut rates much faster and earlier than Powell, I think. Yes, he will. By the way, I was surprised to see Vancouver real estate less overvalued than Toronto real estate. 1 bedroom, 1 bath condos 1 hour away from the city selling for $700K. Yeah, I know. I said the same thing. You know, tell people in Vancouver this. That they're just somewhat overvalued. I think that they were significantly overvalued. But it does take two fundamental measures and two real measures into account. So it does look, let's say that there's a city where, a 200 square foot apartment is selling for $5 million. Completely unrealistic. But the demand is there to rent them for $800,000 a year. So that your payback is 6.5 years, let's say, cap rate of 15%. Well, then that is not, if rents are there, then that property price, if you're getting a 15% cap rate, that's undervalued. Even at that ridiculous price, if a market is there, then its valuation is in relation to the fundamentals of the market, not some absolute price. So it was probably looking at Vancouver and saying, well, look, here's the rental, here's the cap rates on rents, here's the average amount of time, here's the multiple of income that houses are selling for, and looking at those fundamental factors saying, well, it is overvalued, but it's not in that bubble region yet. Again, go back to the 200 square foot apartment that costs $5 million that you can rent for $800,000. And if you can rent them and there are people who are willing to pay $800,000, well, then you have a certain clientele and the market supports a 15% cap rate. At that point, you'd say these properties are undervalued at a 15% cap rate. Okay, mortgage markets in Canada and UK. As you said, those markets have higher share of floating rate and shorter duration fixed rate mortgages. I hear a lot from banks that households can change amortization period beyond 30 years or longer. I hear a lot from banks. What position are you in to hear so much from banks? That would be interesting to know. You'll be paying the same or similar amount every month, although their share of principal would be much less. Clearly a negative shock to consumers. But arguably a short-term hit may not be as drastic because in the end household budgets their spending based on monthly inflows and outflows. Higher inflows thanks to higher wage inflation. Outflows would be higher but not as high because of amortization allows monthly payment to be somewhat flat. I don't know. I will say that all the Canadian banks that reported in the last quarter, all of them raised their loan loss provisions. All of them. So yeah, I don't know. I don't think that more than 30 years is a thing in Canada. 25 years is the maximum, is a 25-year mortgage. I don't know if we have 30-year mortgages. I haven't been in the mortgage market for, 30 years. I've always just paid cash for properties. I've been successful enough to be able to get to be able to do that. But I don't think we have these types of mortgages in Canada, these 30, 40, 50-year amortization mortgages. Now, you may have a mortgage that has gone into negative amortization territory, thereby making it like a 40 or 50-year mortgage. But I don't know that you can actually get those. I think you end up in them, but I don't think you can get those. How will you position your equity and fixed income portfolios for Q4 and Q1? Well, I'm not a good example here because I'm leaving my country. I'm leaving Canada, and I'm taking my capital with me. And to do that, you have what's called a deemed disposition. You're deemed to have sold it at a certain date and paid all the taxes on all the unrealized gains. And of course, you can use your unrealized losses to offset that. But I'm moving into, I gotta do two things: move out of Canadian dollars into U.S. dollars, and I need a vehicle to get that done. The easiest way to get it done is with Treasuries. So I am liquidating a lot of the holdings I have and moving them into U.S. Treasuries to make the move, across a border. So I'm not a good candidate for this question in terms of what I am doing, because I am moving into T-bills and the 25-year bond, a very barbelled strategy in that. And then as duration pays off, I will slowly move into equity at a much reduced valuation than it has right now. Am I allowed to trade the U.S. market if I'm a U.S. citizen residing in Dubai? Yeah, you can. If you have Interactive Brokers, Interactive Brokers lets you trade any market, anywhere, anytime. The restriction with Interactive Brokers is your account must be held in the country that you reside in. So you cannot have a U.S. Interactive Brokers account if you are a resident of Dubai. You must have a Dubai-based Interactive Brokers account, and from there you can then trade the U.S. market. Explain the movement in FCX going from 40.12.35. Copper. It is FCX will be driven by the price of copper more than anything else. That is the one big driver. What are your major learnings from the past 12 months of investing? Some of your ideas did not play out. Well, the last year, macro was tough. Macro did not work, which means beta and duration just did not work out very well. Did the unexpected. But a lot of the micro trades that I've made have worked out very well. The home builders worked out very well. And I reduced my exposure to the home builders a little early, but pretty much at a good time. I got out of REITs when I should have gotten out of REITs. My Canadian dollar hedging against the US for the most part of the year worked out quite well. Most of my micro plays have worked out quite well. The beta trade, not so much. And duration, I'm staying in it. I knew I was right with beta, but I could not live with the constant chorus of AI every single day and the market going up on nothing more than just AI. Couldn't live with that. Duration is a little bit different. It's hard to get hype in there. because it is easier to make much easier for a valuation argument to shine through. And I know I'm going to be right on that. Higher rates longer will break something significant. The Fed will have no choice but to cut those rates. They always do. They always do, and higher rates always break stuff. Always. So this is just a waiting game for me now. But this year, 2023, has been a brutally difficult year for macro. If you were taking a top-down approach, everything just seemed to go the opposite way. So it was brutal on that. But it's the game we play, right? No one in the history of this game has a 100% track record. No one. If we go back to the pandemic years, Warren Buffett sold all his airline stocks and took a hit, something like a $2 or $3 billion hit, only to have the airline stocks go on within a period of 12 months to 18 months to hit all-time highs and huge profitability, right? So no one in the history of this game has a 100% track record. If you're going to be in this game, if you're going to play this game, you are going to be wrong. You're going to have to get comfortable with being wrong. Because if you don't get comfortable with being wrong, you're going to get wiped out. Because you won't stop. You won't stop. You'll just stay in one trade. Now, had I stayed in my short beta trade, I would have been okay. But I didn't know that. All it takes is one trade to not work out for you that you just decide you're going to stay in, and it will wipe you out. So you're going to be wrong. The question is not if you're going to be wrong. The question is, are you going to have the strength to take a loss and the strength to admit, okay, I was wrong, or at least I was wrong for this time period, and walk away from it. That is a stronger thing to do than to say, no, I'm going to be right and I'm going to stay in it, right? And you will every year have at least one trade that makes you smile, and you will every year have at least one trade that will bring you to your knees. That's the nature of the game that we play. If you don't like it, stick with bonds and stick with money market securities, and you'll never lose money. You never make the big money, but you'll never lose money. But if you're going to play, you're going to be wrong. You got to get comfortable with it. I'm a Canadian citizen and current Canadian resident earning $250 annually. I want to live in Costa Rica permanently. How does my tax situation look like? How does my $250 CAD income get taxed in this situation? Yeah, your tax goes to zero. If you move to Costa Rica and you continue to make $250,000 Canadian, your tax rate goes to zero. I shouldn't say zero. Your income tax rate goes to zero, but there's still taxes. There's a road tax, there's a healthcare tax that you have to pay. But after you pay it, you'll find that you are, on a $250,000 income, you might represent 4 to 5% of your income. That's what happens. It drops significantly, and the amount of property and the prestige of the home that you can buy is significantly higher than what you can get in Canada. So you can upgrade to a house 3 times bigger than what you're in, probably for the same price as the house that you have now, in a better climate, and drop your marginal tax rate, which is at 53.5% if you're at 250, all the way down to 5%. What led to your choice of Costa Rica? A combination of development of the territorial tax system and climate. One thing that I was impressed with Costa Rica, at least in the region I was in, the San Jose region I was in, is just the sheer number of charging stations in just strip mall parking lots that are available for EVs. You'll find that in the area I'm in, and apparently we have a green government that's leading, that wants to change everything, and we got none of that going on. So, in Costa Rica, they got all the stores. They got, you go to the mall, and there's no shortage of you would not know that you were in Costa Rica. You'd think that you were in some developed city in the U.S., some major city in the U.S. based on the malls that I've seen. Great restaurants. I didn't see I didn't see an undeveloped country. Now, maybe there are areas of it that are undeveloped, but let me take you through some parts of Detroit and Cleveland if you want to see undeveloped. Let's walk through some of the streets in San Francisco and LA if you want to see poverty and people living on the streets. You don't have to go to any of the favelas in Central America to find the kind of poverty you can easily find in almost every large city in the U.S. With far less crime than you'd find in the U.S. So if you've never been to Costa Rica, go, and then when you come back, you'll have a different opinion about what you saw. How much of our theta allocation can we allocate to TLT? Maybe 30%. Well, I mean, you can think about it that way. If you want to take your theta allocation and do a 60-40 portfolio in the theta allocation, in other words, 60% derived from equity theta and 40% from fixed income theta, you can think about it that way, sure. But you still have to think about the loss that you take. 100% loss, suddenly 30% of your portfolio is taking 100% loss if you're wrong on that one thing. So I don't know that I would do it all on just theta. If you have a 60-40, maybe you say, well, mortgage REITs will count as part of my bond allocation. Maybe different bond ETFs. Maybe you have a 2-year and you have a 30-year. You can have different ETFs for your underlying, so you have different parts of the curve that you're exposed to. But I don't think I would go to 30%, no. On one single name like that, no. The high level of rates forcing large institutional investors like pension funds to rebalance their portfolios by selling treasuries. I think, if anything, they probably want to be buying treasuries, because this is a great way to meet future obligations at these very high yields. They never existed before, so I think, if anything, at the margin, there's probably a greater desire to add treasuries. As rates rise, pension funds' calculated level of liabilities decrease for now, and as rates drop, those liabilities re-increase again, right? So you're going to want some assets that do the same thing. If you're trying to immunize the effect of changing interest rates, at some point rates will drop. Those liabilities, the present value of the pension benefit, the PBO, will increase. You're going to want some assets that do the same thing, and that's the long bond. Where can I check current Fed funds futures for June 24? The CME site. Just go to CME and you'll find it there. Ben Bernanke may have said subprime mortgage issue was contained, but did he actually believe it? I think he did believe it, because the Fed and the Treasury were both taken, were caught off guard when both Bear Stearns failed and Lehman failed. They were both caught off guard. If they didn't believe it, they would have already been doing things to prevent it, including communicating with the larger holders, with the major banks. Do bond indexes normally pay a dividend? The index? Well, any bond index, well, I wouldn't say a dividend. Do they pass through the interest? Even though you get a distribution. Let's call it a distribution. I don't know, I call it a dividend as much as a distribution, because it's passed through in kind. If it's a capital gain, your distribution has a capital gain. At the end of the year, any ETF will tell you, of all the money we gave you, this much was a dividend, this much was a capital gain, this much was interest. So you do get told. An index is uninvestable, though. An index is just an index. You'd need some kind of ETF that tracks the index, some kind of passive investment vehicle that tracks the index. And the index in my 401k, which is offered at my work, BlackRock US Debt Index M, does not look to pay a dividend. The chart is mostly flat. Can you explain this? Well, I don't know what you're looking at, so I can't explain anything. But I guarantee you're not holding an index. An index is a paper portfolio. An index is uninvestable. An index is designed such that products can be created that are investable, like ETFs, like mutual funds, etc. So you're holding some kind of mutual fund or ETF that tracks the index. Now, the index could be a bunch of zero coupon bonds, or the product, the mutual fund that you're invested in may not actually give you a cash distribution, but may actually just give you more units as your distribution, which is very common among mutual funds, is that they don't actually give you anything. That you may start with 100 units and then a year later you got 106 units representing 6% distribution, and you'd still, well, you're in a 401k, so you wouldn't pay tax on that, but it just might be that you're getting more units of a mutual fund designed to track an index. But there's nowhere near enough information in there. Do you have any knowledge of funded trader platforms where you pay to go through a trial or test phase to show you can manage a portfolio, then you're awarded $250K? I've heard of these. I've heard of them. Nothing comes to mind, but I have heard of that if you can demonstrate a track record, you do get an allocation of money that you can then actually start to invest. But I think that's something you'd have to Google. Where do you think Canada's heading economy-wise in the next 10 years, and nothing changed on the political landscape? That is a hard thing to say. It doesn't work that way. It's not a matter of the political landscape doesn't change, where's the economy going to go? It's what is going to happen to the political landscape given that the economy does this? Because it's very hard to get elected in a poor economy. Very hard to get reelected. So, if you think that the political landscape will not change, you must be forecasting incredibly a good economy for the next 10 years. Then voters will see no reason to change the government if everybody is doing well and the economy is doing well. If the economy does poorly, the government will change. It is hard to win when unemployment is elevated and you're in a recession. It's hard to win because you get blamed for all of that. So flip it around. It's the other way. Where do you see the political landscape going if the economy stays where it is right now? I see the Liberals losing significant ground, and the polls are showing that as well. The worst thing that could happen to the Conservatives right now is strong economic growth in Canada. Because then, the Liberals and the Socialists would be seen as a viable government going forward. Second question, Canadian PM just announced $650 million aid package to a foreign land with questionable reputation. Are all the social problems solved in Canada so that we can now dedicate almost $1 billion to something we never benefit from? Yeah, this is becoming a bit of an issue as well, is the virtue signaling the government loves to do around the world. However, it's also part of being a good citizen and for good international relations is that you're seen to help out. So there's, pluses and minuses there. I think a better question is, let's say that they didn't spend that $650 million and decide to spend it internally. Do you, based on what this government has performed and how they've spent internally for the last 7 years, do you really think they would have done anything to solve any of the problems we have anyways? Right? Or would they have used it for their re-election campaign? You get money and you get money and you get money if we get re-elected. I think it would have been wasted money no matter who they gave it to. If they spent it internally, they would have wasted it anyway. So all you can do is shrug your shoulders and say, that $650 million, it's gonna come from you. Somewhere along the road, you're going to have to pay for it. It's gonna come from you somewhere. And that's all the solace that you have. Would it not be more prudent to stop capital and successful people who drive value from leaving by stopping taxing them to death and constantly blaming them for being rich? Yeah, that's exactly what's going on, is we get blamed because somehow being successful is such a terrible thing, and harassing them with all those alternative minimum taxes. Tell that to a politician who wants to get elected. Now, here's the thing. If you pull aside most of these politicians and you give them some truth serum, in 1965, a bottle of red of something or other, they will admit that, yeah, it's pretty stupid, but here's the deal, my friend. You guys are too small to elect us to power. Whereas the unsuccessful and the middle class are large. and we want power, we want our jobs, we want to get elected, we got to lie to them. We got to lie to the people who want to be lied to. So sorry, I'd like you to fund my campaign, but I got to call you names. As soon as I leave this house, I got to turn my back on you and call you names. I'm sure most of them recognize that we're not the enemy. However, we're not big enough to get them elected. It's comforting to hear that no matter what is going on in your life, it's not your fault. It's those rich people. It's those successful people. If they weren't so successful, you'd be more successful. And by God, we're going to make them pay their fair share. They always throw in that their fair share, as if 53.5% is not our fair share. That is the reality of it. If you want to get elected, you have to bash the smallest group. You have to make them out to be the enemy so that the largest group says, I like what you're saying. I like what you're saying. They are the enemy, aren't they? And you have to go after them. But we do have a lesson from an economist named Laffer who created something called the Laffer curve, right? And it looks like this in a very naive sense. And this is tax revenue. And this is tax rate. Tax rate. That's an X. That as you increase your tax rates, you'll increase your tax revenue up to a point. And if you try to increase your tax rates more, you will get capital flight. Capital will leave and you'll have less and less and less. Because when capital leaves, jobs disappear. So they're unemployed, and now you have a shortage because you need more revenue because you've set your budget to this level. You need more revenue. You raise tax rates, you get less revenue, which means you have to raise tax rates more because you need more revenue. You get less, and you end up chasing capital away until you simply just implode upon yourself. And if you want to see this in action right now, California is on the way. Canada is right behind them. That's interesting. Maybe it's something with regions that start with CA that are the problem. Avoid all countries and all regions that start with CA until we can figure this out. We need more research here. There's a nice spurious correlation to run with, right? The timing of the covered short is quite humbling. You're telling me. You're telling me. This is the top of the U.S. housing market. I don't know. I don't think so. Unless, if unemployment stays right where it is, I don't think we've seen the top. If you get a significant bump up in unemployment, I think for the next little while you could see a retreat in housing prices. But in 10 years, housing prices will be 20-30% higher than they are today. So no, this is not the top. It may be an intermediate top. It may be a level for a while, but this is not the top. No. Any comments on India-Canada tensions? Well, I've given this example before, and for Canadians listening, I want you to tell me what you would do. We have one province, Quebec, in Canada, which in the 90s twice had a referendum to split from the rest of Canada as a separate nation. They wanted their own separate state. It failed twice. But let's say that there was a group of Quebecers that decided we can't stay in this country anymore. We're going to move to India. But on the way out, they killed the prime minister. Not Justin Trudeau, a prime minister we actually liked. They kill the prime minister and they move to India and they agitate for a separate sovereign state within Canada from India. There is a plane in India, an Air Canada flight. Let's draw a plane here. That's about to take off and fly a whole bunch of Canadians back to Canada, and this group of people blow up that plane. And you are a Canadian. So twice the referendum failed. A group broke off, went to India, killed the prime minister, and blew up a plane full of Canadians. What would you call them? what would you call those people? What would you demand that our government do? Now, India says, we're not going to do anything. These are people who have a right to protest. They have a right to speak their mind. We're a country of free speech, and India just is not going to do anything about it. Yet, this is what they've done. We would label them as terrorists. We would demand that our Canadian government do something. Something, right? Well, that's exactly what's going on. Just flip it around. That's exactly what's going on. So you have to put yourself in the other person's position and walk a mile in their shoes first before you have some opinion. Right? You can't just look at somebody slapping somebody in the face and say, "Hey, wait a minute, that was wrong." Yeah, but I slapped them in the face because they raped my 4-year-old daughter. Oh, well then that's not enough, right? You must know more than just the action, the proximate action. You must hear everything. Sorry about that example. I know it was a pretty bad example, but you get what I'm saying here is that you have to look at what motivated something. If you were a Canadian and this happened, especially if somebody from your family was on this plane who had nothing to do with anything, they had nothing to do with anything, what would you be thinking, right? So there is my opinion on that. I think Canada is on the wrong side of this argument. They're on the wrong side of it. What does prime here refer to? Can anyone explain? Non-government. So in there you're going to have commercial paper, things like that, something with some credit risk. I'm watching you from Venezuela. I'd like to hear your opinion on Costa Rica and Panama from a real estate perspective. Didn't like Panama. Panama's a little bit more expensive than Costa Rica, and the smell, I'm sorry, but the city had a smell that it smelled like a sewage treatment plant. If you've ever been around a sewage treatment plant, there were days where it just smelled like that. And the humidity was brutal. I didn't get any of that in Costa Rica. Beautiful weather. Don't forget Credit Suisse. Oh yes, let's talk about credit card debt and mortgage rates. Yeah. I don't see something finally breaks. So what? Some badly managed risk-taking companies go down. So what? It's always been this way. It's an engineered crash. They knew it, and they still do it every time. And that is the end of it.